Welcome to another episode of Wealth Uncensored. I'm here with Walter Andreoni today of Marcanti & Associates in Milan, a fantastic Italian international tax attorney that I've known for quite some time and do quite a bit of work with. Welcome, Walter.
Well, thank you, Jimmy. Thank you for inviting me for this. I'm very happy I can share with you a bit of the Italian potential in this field. So very happy for this.
Welcome to the Wealth Uncensored podcast, straight talk about everything that impacts your wealth. In each episode, I share what I've learned through my own experience and 2 decades of helping high net worth clients structure their affairs to minimize taxes and protect their assets for the next generation. I'll also feature special guests who are experts in their own field, sharing their knowledge and experience to help you protect what's yours. I'm your host, Jimmy Sexton. Let's dive into today's show. Today, I want to talk about something that I think is becoming increasingly important to high net worth individuals worldwide, and this is tax advantaged living, right? And I think that this is an especially relevant topic at the moment, given that one of the most popular jurisdictions in the world has long been the UK with its non-dom regime, but the UK seems like they want to make poor fiscal decisions. So they're going to abandon that. And I know quite a few of my UK clients are already looking for alternatives. The UAE is popular. Switzerland has long been a popular destination. But in the last couple of years, Italy's become very popular with its flat tax regime. And I was hoping you could tell us a little bit about what Italy's flat tax regime looks like. I understand you're supposed to pay 100,000 euros a year flat tax, and then basically you don't pay taxes on any income outside of Italy, if is generally correct.
Yes, Jimmy, you are perfectly right. And thank you for pointing this out. The fact that Italy has an increasingly important position as an immigrating country, it's really, if you think, kind of awkward. Italy has always been considered a very high tax jurisdiction, a place with a lot of bureaucracy, a country that you may carefully avoid in every tax optimization scheme. But this is not exactly true. It was not true even in the past, frankly speaking. We have participation exemptions since many years. Nowadays, probably it was not so interesting like other European countries. But at the moment, in terms of individual tax planning and with this favorable regime that we will talk about together, I think it's now at the top of a list of countries that can be chosen by high net worth and ultra high net worth individuals. As you pointed out, this piece of legislation is very attractive. Why? Because it allows a high net worth or ultra high net worth individuals willing to relocate its tax residents to Italy to get rid of all that issues that the Italian tax system is imposing to ordinary tax residents. How do they do that? The legislation is simple, at the same time incredibly effective. What they do, they switch from the taxation on the worldwide income to the taxation on purely domestic income. What does this mean in few words? It means that a new resident is allowed to completely disregard from its taxable base the foreign sourced income and be taxed ordinarily only on the Italian income if this occurs, of course.
Basically, all non-Italian income, regardless of what it is, capital gains, interest, whatever, is not going to be subject to Italian income tax. And only the domestic Italian income would be subject to income tax.
Statement is correct at 99%.
Okay.
And because you touched one point, which is crucial, and it's very good to know, and it must be governed wisely. Correct? All kind of income which have a foreign source, they are exempt with one exception. The exception is constituted by capital gain on non-portfolio shareholding.
This would be what, like an interest in a private company?
Yes, if the immigrant is an entrepreneur with a relevant interest in another corporation, maybe its own corporation, its own business, and is selling this relevant shareholding in the first 5 years from the immigration to Italy, so in the first 5 years, then Italian tax authorities says you are taxed on this, and you are taxed at 26%, like any other Italian. Why this? This has been imposed by the Commission, the EU Commission, as a kind of anti-avoidance regulation to avoid that this system could be exploited for those entrepreneurs that would like to emigrate, sell a relevant business, and then emigrate again. So what this system would like to attract is a genuine change of tax residence, which can be prolonged for a certain number of years, and we will come to that. But on capital gain, there is this exception. After the 5th year, capital gain is exempt because anyway, the nature of a capital gain on the disposal of a foreign shareholding is foreign sourced.
I understand if we have this type of a shareholding, let's say in a private company, and you sell it within the first 5 years, that this is still going to be subject to capital gains tax of 26%. And I mean, I understand the Italian reason for doing this, because like you said, they don't want people just using the regime to come sell something, not pay tax, and then leave. But the question is this: what happens if somebody were to move to Italy with the plan on staying in Italy, but then contribute the shares of this private company into a trust or a foundation, for example? If they were trying to get their estate planning and asset protection plan in place, would that trigger a gain recognition where they would have to pay the tax when they transferred it into the trust or foundation?
This is the scheme that is used. What in general is done is that anyway you disclose this to the tax authorities into a preliminary ruling, you explain the facts, saying also that your immigration is genuine and that anyway, if a sale occurs, you will commit to stay additional time in Italy, not at the end of the regime, but during the regime. So to get rid of this avoidance scheme that can be, let's say, in the back of the mind of the authorities. And this is the way we normally deal with these possibilities of selling relevant shareholding. But if we go to the purely legal point, which is the one you touched, what if I move the direct ownership on the business through a chain of companies or a foundation or a trust? My answer would be, I think it's possible. I think it keeps the whole structure safe as long as the intermediary companies have the full disposal of the potential gain, and they are not considered potentially as conduit. For example, I make always this example: if the individual which is relocating to Italy and moving his tax residence to the country has an holding company through which it owns several businesses, maybe not only one, but more than one, and they're all relevant. And this holding company is a company with a structure, with people working there, with a board of directors which is working correctly, which take decision, which administer and sell shares, cash the amounts, maybe invest in other shares. I think this is a safe way of owning relevant business. But for example, if I just move my shares to a company, which then it's completely related to me as an individual, as an entrepreneur, and do not have any structure, and it's a conduit, then there I may have an issue.
Even though by default, the shares of a private foreign company would potentially be subject to Italian capital gains tax, it is possible to obtain or potentially obtain a ruling that would make it tax-free. Is that right?
Yes, it is possible. And in fact, this shouldn't scare a potential immigrant, because one of the points I always underline is in the life of an entrepreneur, when they have several business, they never know when it's the right moment to exit, right? So maybe they and they think, I will never sell this business because I'm convinced that I will run this business forever. But then when the good chance comes, maybe you want to realize and exit. And if this happens in the first 5 years, I don't want that the person deciding to use the scheme for relocating to Italy have let's say, feel jailed into the restriction or potential restriction of this. So there are ways to deal with that. And we always deal with that through a positive relationship with the authorities by disclosing what is necessary to disclose and explain the situation. Because remember, a genuine immigration opens up the doors of the benefits of this legislation.
Sure.
And the immigration is not genuine, we may encounter issues.
And one of the sort of things that has always made the UK non-dom regime somewhat complex is that you have this remittance basis taxation, right? So essentially, if you're a non-dom there, when you bring in money, there's this difference between clean capital and non-clean capital, and you wind up having to pay some tax on the money, or you could wind up having to pay some tax on the money that you bring into the UK. Now, my understanding is on the Italian regime, you don't have this issue. So that's a big benefit.
Yes, we don't have it because the mechanics of the law is different. The resident dom is reducing your tax bill, if we can put it this way, because you are not cashing the revenues from your activity in UK. So you keep them to the minimum. In Italy, it's different because what you do, you switch from the worldwide taxation principle to a purely territorial system.
Okay.
So it goes one layer lower, I would say.
Does this also then apply to inheritance taxes? So does this mean that there would be no Italian inheritance taxes on everything outside of Italy, just on the stuff inside of Italy?
Yes. Till now, we talked about, let's say, the big side of the legislation, concentrating on the individual income. So we said foreign income is exempt, domestic income, if there is taxed. But together with this, there are several goodies. There are several benefits which are attached to the main backbone of the legislation. Exactly as you pointed out, one is the exemption from the inheritance tax. The other one is the exemption from a gift tax. From the inheritance tax point of view, all the assets which are outside Italy are exempt from the Italian inheritance tax. I always remind that the inheritance tax in Italy is not scary in terms of percentages. It's quite low, I would say. Gift tax has exactly the same cost in terms of tax. But again, gift tax does not apply to a new resident, which means that the new resident may dispose different gift to family members or people he wants without being touched by the Italian gift tax. This is also, I think, very important. It's a way of also an instrument that allows the new resident reorganize his wealth through gift without being harmed by Italian taxation.
But this is only for gifts outside of Italy.
Yes, because again, this stems from the fact that Italy for these people becomes a territorial tax system.
It's a flat tax of 100,000 euros a year. Is that correct?
It's correct for the principle, but then if you relocate, for example, a couple, let's say that the husband is the income earner, principal, he pays 100,000 euro tax. Let's consider the wife that is also an income earner. She can benefit of a discount from this, and she pays only 25,000 in addition. And if they have son or children which are also income earner, they again pay 25,000. And this can be also applicable to parents, to closer relatives. sisters and brothers. So this allows a full family to relocate and get the benefit.
If, let's say, the spouse was not an income earner, would they still be able to get legal residency because they're married? The tax is somewhat irrelevant if they're not making any money.
Yes.
They just wouldn't get the benefit of the regime unless they were paying this additional amount of $25,000.
Exactly. If it's possible.
For how long can you do this regime? How long is it good for?
The regime lasts 15 years. That doesn't mean that you are locked in the regime for 15 years. This is the maximum number of years applicable to a new resident, which means that if after 1 year, 2 years, 5 years, 8 years, you would like to exit for any reason, you exit from the regime without any additional taxes.
What kind of security does the individual have that this isn't going to get changed? Because, I mean, if you look at Portugal, for example, over the last 10 years, how many times they've flip-flopped on their tax regime. And I'm not comparing Italy and Portugal, but I'm just saying that it is a potential concern. What sort of security does someone interested in taking advantage of this have that Italy's not going to change their mind in 2 or 3 years?
Of course, you never know, right? It's impossible to really understand what will be the next move of a government, or when the government changes color. Whatever happens, we do not know. What I can tell is, first of all, this system has been introduced in 2017, and I can tell nowadays it's probably the most stable, attractive regime for individuals in Europe. Never changed since then. Second, if there will be a change, this will not change the status of the individuals which are already in the system. And this is a constitutional protection we have. Tax legislation cannot be retroactive, right? You cannot change what has been given in the past. This is from the Constitution. As long as you get the okay and you are an option, this should last for the time you have available.
You're able to take advantage of this by paying this flat income tax. You're not required to actually make any investment in Italy. So you could, for example, rent if you wanted to rather than purchase real estate. Is that right?
Correct. The only thing that really matters is your tax residence. So you need to get an Italian tax resident, a genuine one.
Some of the countries that offer these tax advantage regimes require you to physically be in the country 183 days a year, which for a lot of high net worth individuals is somewhat problematic, not because that's not where their main home is, but they travel a lot for business. They probably have multiple homes in different countries where they spend a little bit of time. So what are the requirements in terms of spending time in Italy? Do you have to stay over 183 days or how does that work?
This is probably one of the most difficult questions to answer because, as you know, tax residence has different rules in different countries, and every country maybe give a different weight to several requirements in order to consider a person to be a tax resident. But at the very end, the tax residence is a matter of substance. And Italy, if we look at the domestic legislation that changed not long time ago, it's a change in the wording, but let's say the main nuances of the tax residence concept remained at the very end quite unchanged. To me, the main idea is tax residence has a substantial criteria, which is where the center of your vital and economic interest is. And this brings us to the fact that at the very end, it doesn't really matter how many days you spend in the country, but it matters how you behave towards that country. So to make an example, when a genuine emigration to Italy, of course, needs the family, if there is a family, to be in the country. You cannot think of having a wife or husband and children in one country and you pretending to be an Italian tax resident. This simply doesn't work, even if you stay 200 days in the country, right? Because it's simply not realistic that the center of your vital interest is here and not where your family ties are. The same also can be pushed forwards toward having many properties which are still available in one country, your emigration country, and maybe just poor property in Italy. So you need to make a decision. And when you decide to emigrate, you need to understand that your wealth should be administered in a way that Italy becomes the center of your decision making. It's the place where you sit and administer your wealth. If you do like this, if you act this way, it's clear that the tax residence is Italy and not another country. I just add a little point to this. You shouldn't be scared when you emigrate to Italy that it's the Italian authorities which tackle you saying, oh, but Italy is not your tax residence. But it's a matter of defending yourself from the country you are exiting, because this is the country which feel defrauded, let's say, of the rights of taxing your worldwide income. Okay? So this is a little nuance that we need to have in mind to make a perfect scheme.
I think that that's a really good point, and I think that that's, a point that most people usually miss, right? Because a lot of people are always asking me, mostly in regards to the UAE, well, how much time do I have to spend in the UAE for, Germany not to attack me? My answer is, listen, the UAE doesn't care, right? And Germany doesn't care whether or not the UAE considers you a tax resident. What Germany cares about is whether you meet the definition of a resident under their laws. So it's not so matter of looking at what qualifies you as a resident in the UAE. It's looking at what disqualifies you as a resident in Germany. How does it work with tax treaties if you are under this regime? You have access to tax treaties?
Even if you are taxed on a flat tax base, you are considered by the Italian authorities as a person fully liable to tax, which means you have treaty entitlement on all the Italian treaty network.
I think that's incredible. I mean, it's maybe the best regime I've heard of. If somebody wanted to get set up on this Italian flat tax regime, what does the general process look like? How long does it take?
The general process, that it's the one we always advise, is to have access to the regime after a positive answer of the tax authorities that you as a taxpayer has all requirements to have access to this regime. And one of the basic rule is you can have access to this regime if you are able to prove that in the last 10 years before immigration, you have never been considered an Italian tax resident for at least 9 years over the 10 years observation window. This is to get rid of all taxpayers which had strong ties with the country, but then they left and now they want to join back because of this regime. Again, it's a kind of anti-abusive requirement. We always advise to go through the ruling because the ruling is requested to the central office in Rome of the tax authorities, and they deal with all these issues. They can also answer questions on the structure you have if we are unsecure and we are not certain that this structure is paying foreign source dividends, so covered by the umbrella of the 100,000 euro. There is also another option, which I call the kamikaze option, which is the one to do it yourself, like simply opt in the tax return. But if you opt in the tax return and then it's not, the option is not valid, you wake up in the nightmare of being considered an Italian tax resident fully liable on your worldwide income, thinking that you could be covered by the 100,000 euros. So that's the worst nightmare ever. I never advise this. You have to avoid it and use the instrument of the ruling in order to get an immigration which is 100% safe. In terms of timing, 4 months.
Can an Italian citizen qualify for this if they've been, let's say you have an Italian citizen that's been out of Italy for 15 years and now they want to come back?
Absolutely, yes.
That's very good. So basically, the process is you request this ruling that you qualify for this, and then essentially, once you get the positive answer, then you just file your tax return, check the box, pay your $100,000, and you're good to go.
Yes, exactly like this. You need to be just a bit attentive to the timing because let's make an example. A person which emigrates in Italy in 2024, so it's eligible as the first year of regime for 2024, will have to file a tax return in September 2025, ticking the box and opting officially for the regime for 2024. And he has to pay the first 100,000 euro by June 2025. Okay, that's the timing. You first pay in June, and then you make the option in September. Where is the optimal decision making and let's say step is if I want to be a tax resident in 2024, it's the best is to have a positive ruling already issued in 2023, so that my first year of full tax residence, it's already covered by a yes by the Italian authorities. So that's why we need to plan it in advance, not being afraid of making a step forward just before, because in this case, timing is key and reduce the risk to minimum.
And this is obviously something that you can help people set up, right? You can help them get the ruling and advise them on when to pay the tax and all this kind of stuff, right?
Absolutely. We take care of all the tax process on this. We do more because in order to be considered a tax resident, if you are a non-EU person, a non-EU citizen, you need civil law instruments to have a title to reside in the country permanently. So we also help clients in getting the visa they need for and the residence permit. And this is dealt by our civil lawyers, which are trained also on this, so that we can bundle the whole thing together and the client have a kind of one-stop shop getting services for the immigration and from the tax side in order to do the immigration process as smooth as possible.
Walter, if somebody wanted to get in touch with you to get the flat tax regime handled up or any other Italian tax matter for that matter, how would they go about getting in touch with you? What's the best way to reach you?
Well, the best way is write us an email. You can find my profile in LinkedIn. You can find my profile on the website of our firm. And this will be the best way to enter in touch with me. And we would be happy to first have a full screening of the wealth structure of an immigrant, potential immigrant, and see whether there are points to be addressed before the immigration and go further with the process.
Walter, I'll make sure to put your firm, Acanti & Associates, website in the description of this podcast so that people can find you easily. It's always a pleasure speaking with you. Thank you for your time today. I really appreciate having you on the show.
Thank you very much, Jimmy. It was a pleasure for me to have a chance to discuss these matters with you in this context of political instability around the world. I see an increase of demand for this kind of services, and we understand the pressure on which the high net worth and ultra high net worth individuals are in this moment. And we are always happy to help and give a chance to make a better planning.
Thank you for joining me on Wealth Uncensored, where we help you minimize taxes and protect your wealth for the next generation. If you like our show, be sure to subscribe and leave a review. And if you have any questions or suggestions for future episodes, we'd love to hear from you. You can email us at info@esquiregroup.com. And don't forget to visit Esquire Group's website for more information on how we can help you secure your wealth. I'll be dropping knowledge again next week. Don't forget to join us.